We're in the final week of the month, the quarter, and the first half of the year. And it's been really interesting as a market spectator, but from where you sit, running a custody business, given everything that's happened this year, what is your big takeaway on the year so far?
Well, I think the institutions and the institutional investors are all looking at regulatory right now. So, I mean, obviously, the regulators take a very heavy hand here in the United States. And then we start to see some resistance back on that in the court system. And of course, we're seeing across the globe, regulators taking a different approach that are actually writing down, here's the path for which you come under compliance and operate your business in our country. So all of this is just leaving, everybody watching and making sure it comes together. I think the net effect is that, here in the US, the traditional financial firms are going to remain mostly out. I know we've got BlackRock that's coming in with an ETF. There's going to be a few exceptions like that, which is great. Frankly, the number one thing we could have for safety of our markets would be to bring a path where everybody can participate. And because it's not going to be perfectly clear, some of the crypto native firms that have been growing and building quite large businesses like BitGo are going to emerge, providing technology solutions that far exceed just like the how do we take an ETF to market.
Okay, so you hit on some themes here. The regulatory crackdown and the pressure we've been seeing all year. There's that to contend with. When we started this year, we were kind of in FTX recovery mode. There was a banking crisis, and yet all of, like you just noted, all of these institutional announcements that came rolling out last week. So all these institutions kind of signaling their seriousness about crypto's place in the future of finance or the future of their businesses. Kind of square that circle for me.
Well, downturns in the market are always opportunities. So I think there's a lot of participants that are seeing this right now. And in the wake of FTX, it's a bit of a wake up call, right? Like, guys, we got to get serious about how do we build de-risk safe markets. So what's going on is you're seeing from the digital asset, the crypto side, the Bitcoin side, technology paths to make that come forward. And then from the traditional side, you're seeing a few players that are like, wait a minute, we can actually make the ETFs work. This is an opportunity. We think that, the regulators need our help, and, we can come up with a path. Some people call that, maybe handing it to the traditional firms. I'd like to think it's not so deliberate, but nonetheless, it's a downturn. It's a good time to be building, and coming out the other side of this, which is not going to be far away, we're going to see a really strong Bitcoin digital asset market.
Given all of those big major events, what have we learned from each of these moments? And specifically, what are some of the actionable teaching moments that we've seen over this past half of a year that can take us forward into the next thing? Great.
Well, look, I mean, I do want to talk about like the BitGo Go network, which hits on two key components here. I mean, one thing we saw the fiat rails into crypto, where we had basically put the burden of $1 trillion industries banking all on one small state chartered bank here in California. That was Silvergate. And then we realized what happens when there's concentration risk. Now, frankly, I think regulators could have helped avoid this by making a clear path for banks to be able to participate with digital assets. They failed to do so. So only a few banks were able to participate. And, we suffered concentration risk. And by the way, it's interesting to note that of all the banking failures, the Silvergate failure was relatively small, and that everybody gets their money back. All right. Anyway, BitGo is addressing this by way of building, on-ramps. It's a Silvergate exchange network. It's a post-trade settlement replacement, but it's better. Instead of being fiat-based, it's fiat plus crypto, delivering full DVP, delivery versus payment, as you would expect. The second thing, and this is out of FTX's failure, these pre-funding of exchanges where there's no checks and balances, where there's no separation of custody from the other assets that you have at your market participant, whether it's a broker-dealer or an exchange or anything else, we've got to stop that. And so BitGo is just launching this week. We're launching it with Bitstamp. INX is part of it, coming soon. Gate.io as well. There'll be more coming. But basically a true settlement network where you can keep your assets in qualified custody all the time. You can trade over at Bitstamp and the various exchanges, and then it settles back behind the scenes automatically. So the benefit to investors, the thing that the investors are looking for is how do we de-risk these trading systems so I don't have to take it out of qualified custody in order to have access to liquidity. And we've built that. It's the first of its kind. I'm very excited about it this week.
Okay, so sorry, you said you're launching or you're announcing it this week? Because I think I recall hearing about this from the BitGo blog. I think it was in October of last year. So when did this go live, I guess?
Well, it's been growing in functionality, and what's launching this week is the first integration with a real a tier one exchange, that's Bitstamp. It takes time to get various market participants to all come together and figure out how we're going to do settlement, and so that's starting to happen now. There's been a few fits and bursts kind of in the industry, but we've never seen one coming straight out of qualified custody like this.
How does this compare or compete with something like EDX Market? So that's the so-called non-custodial exchange that we heard about last week. It's backed by giants like Citadel, Schwab, Fidelity. So the Go network is not an exchange, but it has exchange partners, some of which you just named. And for the audience, BitGo does separately offer a prime brokerage service, but would something like EDX Markets be a potential partner for you?
Definitely a potential partner. So look, I think the EDX team is going to go straight after kind of replicating the existing traditional finance markets. That'll have some goodness with it, and that'll have some less good with it. We'll see how they evolve. I'm very excited about what they are building. But like with a lot of things with this technology, there's new capabilities that have been unlocked here. I know that there's some disputes about what's a security, what's not a security. But the technology is going to matter tremendously. How do you interface both to centralized markets and decentralized markets? How do we provide the transparency that's inherent with Bitcoin into these markets? And the traditional players are going to be more interested in just kind of replicating the status quo. I think there's some that want to make a lot of money because they see a way to just like participate in the trade aspect. I think for others of us, we're actually much more interested in building a broader, more global, more transparent network.
So you must have known this need to prioritize custody and kind of bring together, in order to bring together both, the best of crypto and the best of traditional financial institutions and market structure, that was coming. You've been in this business for 10 years or so. How clear was this moment to you? I mean, obviously, I'm sure you didn't predict that this is how it would become a big priority for the space. But, just taking into account the fact that you did start working on this, or at least you teased it to us in October of last year. So that was ahead of the FTX debacle. How did that start? How did that start?
It actually goes all the way back 5 years. So we first started putting together vision decks around, how do you start to build market structure? So BitGo's overall thesis is that we want to deliver trust in digital assets. That means at a technology layer, we provide technology that you can count on and trust. You're not going to lose your money. At a regulatory layer, that means that we're going to be a fiduciary. We're going to be somebody you can trust and count on, and we combine that fantastic best-in-class technology along with best-in-class, service. And so we hit that towards the institutional market. But then lastly, we're operating inside of this crypto market, which hasn't really been defined. And having this single verticalized stack at an exchange where they act as buyer's broker, seller's broker, the exchange, the custodian, the clearinghouse, all in one function, it leads to problems. So anyway, we started working with, by the way, traditional financial firms and saying like, what should the market structure look like? Should it look like the CFTC? Should it look like the SEC? Should it look like something different? But one thing that's been clear for at least 5 years is that no, you can't have the guys that are handling the assets be the same guys that are trading the assets. You have to separate these functions. You need it for safety. And then I think what we've learned from FTX actually is a couple of things. A, we learned where there are some weaknesses with individual players in the digital asset crypto markets. But B, we learned we haven't been moving fast enough. Although we have had these concepts for 5 years, we haven't really been pushing and making it happen. Risk is something you can calculate into your business equation. You can say, look, I need to cover my profit. I need to cover my risk. But at some point when you get stung, that risk is too excessive. And you realize, this isn't good business. And I think crypto was operating, on the edge saying, yeah, it's risky, but we're making a lot of money right now. And at this point, I think everybody's ready to come back with a more mature response. People are stung by FTX in a pretty significant way, and that needs to be fixed.
like I said at the start, we are heading into the next half of 2023. So in the next 6 or 7 months, potential headwinds and tailwinds that you're watching in crypto and specifically for Bitcoin.
I would say it's all regulatory right now. So look, I mean, I think we're excited about what can happen with BlackRock. Will there be an ETF? That'd be great news, obviously, here in the U.S. But I think in terms of really building more interesting networks around Bitcoin, there's going to be a lot moving abroad. So we have to figure out how do we create stability that's not dependent upon a single jurisdiction or a single regulatory whim. And we've definitely seen regulatory whims in our industry. So how do you fix that? Look, I think we need to make it that this is a global product and it can be offered up under many jurisdictions, and people can kind of choose like what's the right kind of rulemaking that they want to have around them.